It looks like the latest rush is in. It's almost 2:01. So let's go ahead and dive in. I'm Katie Rand. I'm a partner in the employment group at Pierce Atwood. And I'm joined today by my partner, Dan Strader. And we're here to talk about wage and hour issues specific to your industry. A special thank you to Hospitality Maine for helping us get the word out about the webinar. We have a lot of material and we're going to move fairly quickly. Some of the material, particularly at the beginning, some of you may find sort of elementary if you have some experience in wage and hour, but we think it's important to cover those basics before we get into some of the more complicated stuff. And I will share that some of the material toward the end of the presentation is fairly complicated. And so if you're struggling to grasp it, that's not because you're lacking intelligence. It's because it's really complicated stuff because of regulators. And so I just want to, at the outset, offer up an invitation to contact us after the webinar if you have specific questions. If they're a group that would like to hear more about something like service charges or whatnot, please let us know, and we're happy, excuse me, happy to schedule a follow-up webinar. Okay. These are the subjects that we're going to be covering today. Initially, just overtime, exemptions, misclassification, how you classify your workers. And Dan's going to kick us off in a minute. We'll talk about the tip credit, what it means and doesn't mean, how you claim it properly. We'll talk about tip pooling and tip sharing. We'll talk about how to calculate overtime for your tipped employees, which is one of the most common errors I would say I see when I'm representing hospitality clients in the context of Department of Labor audits, for example. We'll talk about service charges, which is where things will get really wonky and complicated, joint employment, and then Maine earned paid leave. And it's our intent to save a little bit of time at the end for questions, but I will see how we do. If you have a question as we're going and you need some clarification, you can pose that question one of two ways. You can either type in the chat and one of us will try to be monitoring that, or feel free to raise your hand and one of us will call on you to go ahead and unmute yourselves. Okay. With that, I will turn it over to Dan.
Thanks, Katie. And again, welcome everyone. As Katie said, my name is Dan Strader. I'm a partner also in our employment practice group. And I am going to start things off on a fairly basic level, tailored, however, to the hospitality industry. And I think we'll ratchet things up as we go along. One thing that we wanted to point out just at the outset, and I don't really have bullet points for this slide, it's just sort of an a basic principle that we wanted to put out there, which is as employers in Maine, you're required to follow both state and federal law. And really you're just required to follow whichever one is more beneficial for the employee or more restrictive on the employer, depending, I guess, on your perspective there. And in some cases, even local law. So as everyone sort of in the Portland area, I'm sure is aware, Portland has had its own developments with the minimum wage over the last couple of years. And so there can be local laws that come into play as well that you also need to monitor. In our case, we're going to be talking a lot today about Maine law, because Maine law tends to be the most protective or the most beneficial for employees in most of these instances. Katie, though, is going to point out a really important distinction where in one case federal law is more protective or more beneficial for employees. So just important to recognize as a general matter that both of those apply. So we're going to start by talking about the difference between exempt and non-exempt employees. This is a pretty basic distinction that applies in every industry. I'm going to try to highlight sort of examples in the hospitality industry, but the general rule is unless employees are, so exempt and non-exempt, those terms mean someone is exempt from overtime. So they would not be required to be paid overtime if they classify or if they qualify as exempt. If they're not exempt, it means they're non-exempt. That's the default. And everyone, unless they qualify as exempt, is non-exempt, and they're entitled to receive overtime pay if they work more than 40 hours in a work week. There's a variety of different kinds of exemptions. What they all have in common, though, is that exempt employees are not entitled to receive overtime. The exemptions that we're going to talk about, and there are some that we're not going to talk about, that, there's agriculture, for example, but the ones that are going to apply here, all of them require two conditions to be met. One is that the employee receives a salary at a certain minimum level. Federally, that is now $684 per week. In Maine, the salary is tied to the minimum wage. So because our minimum wage is indexed to inflation and it will increase every year at this point, so will the salary threshold. I suppose it's possible it could decrease, but I think that's not likely. But it can change every year, we should say. So you have to make sure you check it every January 1st. It can change year to year. Currently, it's a little over $735 per week. And so the first condition of that exemption is that you need to pay the full salary for any week in which the employee performs any work at all, whether it's 1 hour or 100 hours. And there are a few exceptions we're not going to talk about today for certain deductions that are allowed. But for the most part, the rule is you've got to pay the full salary regardless of the amount of work performed. And the second condition for all of these exemptions is that there's going to be certain job duties requirements that have to be met. So the employee, you can't just pay someone a salary and call them exempt. They've got to both get the salary and perform certain duties that we'll get to on the next couple of slides that are specific to each one of these exemptions.
I'm working on it.
There we go. So the first exemption we'll talk about is called the executive exemption. And this is essentially the exemption for managers and supervisors, or even up to a CEO level. The duties test for this exemption is that the employee's primary duty needs to be management of the enterprise or some subdivision of the enterprise. So in a restaurant, for example, the front of house might be a division, the back of house might be a division. In a hotel, the banquets, might be a division. So they have to manage some section of the enterprise. They also have to customarily direct the work of at least two full-time employees. And it's important to recognize these have to be employees, not contractors. Supervising contractors doesn't count. And full-time employees, it's or their equivalent. So in total, they need to supervise 2 or more people whose hours add up to 80 hours in a work week. So it can be 3 employees that have 30 hours each, or 2 that have 40 hours each, or whatever gets you over 80 hours combined. And it can't be one person to work 80 hours either. It has to be two people working at least 80 hours total. And then the third criteria is that they have to have authority or at least significant input into decisions regarding hiring and firing. So if they supervise one person, they're not exempt. If they if they supervise people, but they don't really have any authority to make hiring and firing decisions, they're not exempt. So the most common people that are going to come into this are going to be, again, kitchen manager, front of house manager, someone who's in charge of some portion of the business. The second exemption, and I think this is the most fraught of the exemptions that we're going to look at, because it is kind of vague in terms of the criteria. I'm going to tell you what they are. I can't say with any clarity without looking at a really specific example how it might apply to a certain person. I sometimes call this like a grab bag exemption, and I think it gets employers into trouble a lot of times. But what needs to be present here is you have to have the primary duty of performing office or non-manual labor. So it's not going to be somebody who's out on the floor or working in the kitchen doing physical work. They have to be sort of in the office. And this is something that often gets overlooked too. The work that they're doing has to be geared towards the business. I always think of them as they are servicing the business. They are not servicing your customers. So it's not someone who's engaged in customer service who might be sitting in an office handling phone calls from customers. It's people that the classic examples are human resources, bookkeeping or accounting, marketing, So maybe you have a social media person, that might be somebody who qualifies. But it's going to be people who really service the business, not your customers. So that's sort of criteria one, is this office and non-manual work. But the second criteria, and this is what gets really, I think, tricky, is they have to exercise discretion and independent judgment with respect to significant matters. One obvious example is if they have a significant matter would be, for example, signing contracts on behalf of the employer, making purchasing decisions on behalf of the employer. But this, the discretion and independent judgment piece is where it gets really vague sometimes. But I think, the way I try to think about it is, they need to be able to weigh more than one course of action and make a decision. So if they're following sort of a playbook, or there's a well sort of defined type of decision-making tree that they should be following, then they likely aren't going to qualify. They really need to have kind of independence to make decisions where there's multiple choices at play. And so, we caution at the end that, just working in an office, and this is what I see often that is problematic, is that someone is, they work in an office, they're paid a salary, and it oftentimes sort of feels like an exempt job. But if they don't meet these criteria, then I think it's hard to justify. The next two exemptions we'll talk about are pretty closely related. They're both versions of a professional exemption. And they both can apply in the restaurant or in the hospitality industry, but in a fairly limited way. So the first one is the learned professional exemption. And this requires that the work requires advanced knowledge in a field of science or learning. It's intellectual work. The classic examples are like accountants, doctors, lawyers, people like that. So in a larger organization, your CFO probably is going to qualify as a learned professional. And there needs to be there basically needs to be an advanced degree. It is possible to acquire the necessary level of experience without a degree if the job generally requires a degree, but I think that's risky. I think the general rule of thumb, the easiest way to think about this is it's a type of field that requires a degree. So that, CFO that has an accounting degree, for example, or a finance degree is an example. Just having a college degree and working in a sort of an unrelated field that maybe you gathered, through experience is not enough. That there has to be sort of a relationship between the degree and the job that's being done. Where this, I think, comes into play in the hospitality industry, or one way it can come into play, is with an executive chef or sous chef. The Department of Labor has regulations on this, and I think even in this context, it's a little bit uncertain, because some courts have said that culinary arts is not a field of science or learning. But the Department of Labor does have a regulation that it enforces, and courts have upheld, that says if you are a chef with a 4-year culinary degree and your primary role is sort of operational management or menu design and sort of the planning parts of the business rather than the working on the line parts of the business, then you can potentially qualify as a learned professional. But they are very specific. It has to be a 4-year degree. So like a place like CIA, for example, a 2-year associate's degree in culinary arts is not sufficient. It's a very specific regulation. And then the next exemption that is related is the creative professional exemption. And this isn't science or learning, degrees. This is a person who is essentially an artist. It's painters, writers, photographers, sometimes graphic designers. So it's people that are using artistic creativity and their own imagination to create original work. And that can also include an executive chef, but again, it's pretty limited. It's their primary duty is regularly creating, the menu, essentially creating unique dishes, and they limit it to, these are quotes I took from the regulation. They limit it to 5-star or gourmet establishments, and truly original chefs. So, where is that line? It's a little bit hard to say. I've seen cases where the parties are arguing about how many Zagat stars the restaurant has, and is that really a gourmet establishment or not? And I think it can get really close. But I'm sure there certainly are some places locally that I think would qualify, but I would tend to view that fairly narrowly in terms of sort of how it would have to be a very kind of high-end fine dining place, and they again cannot be routinely involved in sort of working the line, expediting, doing sort of physical work. They really need to be more of a behind the scenes person who's doing the creative side of the business. So if someone does not fit in one of those 4 exemption buckets that I just mentioned, the default is that they are non-exempt. And someone who's non-exempt is entitled to receive overtime. A non-exempt employee can be paid on either an hourly or salary basis. A lot of people think that it has to be hourly, but you can have a non-exempt salaried employee. But you just need to make sure you are paying an overtime premium once they get over 40 hours. And we're not doing the math on this today, but we can certainly talk about that offline if you have questions. But you have to sort of divide the salary by the hours and figure out what the overtime premium is based on that. And as we probably all know, the general rule is it's time and a half the regular rate for hours over 40. You also need to maintain time records. So you don't need time records for exempt employees. And you normally wouldn't have them, but with a non-exempt employee, even if you've paid them totally correctly, just not having the records is a violation in itself. And of course, it's an evidentiary problem as well. I mean, if someone's claiming I worked 60 hours a week and you say, no, you weren't, that's insane. You worked, 42 hours a week and we paid you for it. You don't have time records. There's a lot of weight given to the employee's, testimony on that. So, you want to have the records to cover yourself as well. So if you misclassify someone as exempt that should have been non-exempt, and presumably you weren't paying them overtime, there can be pretty heavy consequences in terms of recovering, the unpaid overtime that should have been paid. So, one point I actually meant to make on the last slide that I'll make here is the time and a half that you are paying. It's the employee's regular rate, which is a defined term. It's not their hourly rate or their base rate of pay. The regular rate includes a lot of other things, commissions, most bonuses, certain charges that certain service charges that Katie will talk about later. So there are more things that go into the regular rate than just whatever their base hourly rate is. And all of that needs to be taken into account when you're doing that time and a half calculation to figure out how much they're owed. If you misclassify and you haven't been paying overtime, again, the employee's testimony is likely to carry a lot of weight in terms of what a court or a fact finder is going to believe the hours worked were. You'll have to pay the back wages, and then all of the relevant state and federal wage and hour statutes have provisions for what they call liquidated damages, which is either in federal law means doubling the damages, or in state law in Maine, it means tripling the damages. And as you can imagine, let's say you have a misclassified employee who works 5 hours a week, their overtime rate would have been $30 an hour, their time and a half rate that they didn't get. And that's, $150 a week times they can go back as far as 6 years under Maine law. You can imagine that these numbers can get pretty big, pretty fast, and then you're going to double or triple it on top. So it's definitely an important thing to put a lot of thought into, and make sure if you are, you're never going to get in trouble for classifying someone as non-exempt that could have been exempt. But if you're ever thinking about paying someone a salary and not overtime, you just want to make really sure on the front end that they can meet the tests. So I'm going to transition now into the tip credit. So we're kind of moving into the more hospitality specific piece here. I think there's often some confusion or misunderstanding about what the tip credit refers to. And so I want to just get the terminology straight. A lot of people think about the tip credit sort of as this is the amount I'm paying and it's this lower minimum wage. I don't have to pay the full minimum wage. I take the tip credit, I pay this lower minimum wage. That's true, but when you pay the lower minimum wage, that we would refer to as the cash wage. The difference between the cash wage you're actually paying and the full minimum wage, that's the credit. That's the piece that you're not paying. You are using tips to satisfy that portion of the minimum wage. So in Maine, as an example, our minimum wage is $12.75 an hour. Every employee needs to be paid $12.75 an hour, one way or the other, whether it comes directly from the employer or whether it comes from the employer plus tips. So if you pay $10 an hour, you're taking a tip credit of $2.75 an hour. And you need to make sure that the employee actually gets $2.75 an hour in tips. And if they don't, then you need to make up the difference at the end of the week as the employer, because they are still entitled to the minimum wage. Another requirement to take the tip credit, you can't just, obviously take it with anybody. You can only take it with respect to tipped employees, or Maine uses the terminology service employees. And those are employees that are engaged in occupations where they customarily and regularly receive certain minimum amounts of tips per month. It's not a large threshold. Federally, it's very low. They just need to receive $30 a month in tips. Maine has recently changed their law again to index it, where it's going to continually increase. It's currently $100 per month in Maine. I believe, Katie, maybe you can correct me if I think it's going up to $150 next year. It is set to increase. Do you know the number?
Nope, I don't.
Yeah,
I do. It's 175.
Is it 175? Okay, so yeah. So
and then it's CPI, like you said, Daniel.
Yeah, so so that will continue to increase as well. So that's just something that, again, bears monitoring. But if someone does not, is not in an occupation where they receive that much in tips a month. Now, we were talking about this. What I think this means, what we think this means is, if they're in a job waiting tables, for example, if somebody, that is a job that regularly receives that much in tips, if you were to look at your workforce as a whole, if somebody, takes most of the month off or something, and they happen to only work one day, they didn't make that much money, I don't think that's a problem in itself. So it's less about the individual level and more about, your overall workforce for that job classification. How much do they make? So the current tip credits or minimum wages and tip credits that apply here, federal law, the minimum wage has not changed since I think 2003 or 4. It's $7.25. That seems very antiquated, I'm sure, in most places, but especially in Maine. You're allowed to only pay as low as $2.13, and you would be then taking a tip credit of the difference between those two, which is $5.12. We can't do that in Maine. So in Maine, the minimum wage, again, is currently $12.75, and Maine's tip credit is not a specific dollar figure. It's up to 50% of the minimum wage can be taken as a tip credit. So, and it can't be more than 50%. So because we have an odd number minimum wage now, when you divide it, you need to kind of round up the cash wage. So the cash wage here would be $6.38 in Maine is the minimum you can pay. And the maximum tip credit you can take is $6.37. But again, you can, and many restaurants, many employers do take a lower tip credit. You might pay a $9 wage, and you're then taking a $3.75 tip credit. And then I've listed the tip credits for the other states that we're not really covering today. There are some other prerequisites to taking the tip credit, and this is one that we have often found missing from personnel files when we sort of do audits and look at these. You have to notify employees of your intent to utilize the tip credit at the outset of employment or before you take the tip credit. That is not required to be in writing, but I would recommend that it should 100% be in writing, because it has to be very specific. And if there's any question, did they receive this part of the notice or that part of the notice, or how did you explain it? Was it clear? You want to have that in writing, signed by the employee. So what the notice has to include is it has to say the amount of the cash wage that you're paying. So I'm paying $9, and the amount of the tip credit you're claiming. So if you're paying $9, I'm taking a tip credit of $3.75. You have to have a statement in there that the tip credit will not or cannot exceed the amount of tips actually received. So I'd mentioned that earlier. If the employees are not making enough in tips to cover that $3.75 per hour for all hours worked at the end of the week, you would have to make up the difference as the employer. And you have to have a statement in there that says that the tips are property of the employee and are retained by the employee, except in the case of a valid tip pool. Katie's going to talk more about tip pools and how they work and what you can and can't do in a tip pool. I would suggest to you that if you do use a tip pool, you either have that tip pool and its rules explained in the same tip credit notice or in some other notice, but that ought to be in writing as well. And if you don't provide this notice, then you are not entitled to the tip credit. And that can be a really big problem. So I want to just, focus on that. I mean, if you had, just like with the misclassification case, if you have not been entitled to the tip credit, let's say you have 10 servers in your business or 10 tipped employees, and you're taking a $4 an hour tip credit that you were never entitled to take because you didn't have this notice, they can look back years and $4 an hour for every single hour worked by every one of those people. That would all be money that is required to be repaid to them, even if they earned a whole bunch of tips and were, never received below the minimum wage. It's just, you're not entitled to take the tip credit if you don't do the notice.
Before I advance the slide, and at the risk of beating a dead horse, I had a client, a restaurant, maybe 7 years ago. Every single server there was a very long-term server, in the industry. They all knew what the tip credit was. They knew what it was. There was no formal notification, however, and that restaurant ended up having to pay the other half of the minimum wage going back a very significant period in time. So it feels like such an unfair and sort of ridiculous requirement, frankly, especially in the context where you have servers who know the industry and the rules, but it's a requirement.
Now, there are some other limits on the tip credit, and these rules have changed quite a lot in the last 3 or 4 years. I think they've gone back and forth maybe 3 different times. There was some revisions to the old rule under the Trump administration. Those were blocked by a court. Then they were rewriting the rule. Then the Biden administration stopped rewriting the rule and they wrote their own rules. So you should be, you should forgive yourself if you haven't kept up with all of these year to year, because it's complicated and hard to keep up with because it's changed so much. This is the rule as it went into effect this December, or I guess it's last December, so just a few months ago. And this is sort of how things currently stand. You should think about your tipped employees' work flow or their work duties in terms of 3 different buckets. There's tip producing work, there's directly supporting work that supports tip producing work, and then there's non-tipped work, and they all get treated differently with respect to whether or not you can take the tip credit. So tip producing work is direct service work, taking orders, serving food, parking cars for a valet, moving bags for a bellhop or something like that, chatting with customers, those activities that are directly related to the effort to produce tips. You can always take the tip credit for that work. Then there is, I'm actually going to skip to the last one, so I think it's a little bit easier to sort of go to the opposite extremes. There is work such as cleaning the bathroom or sweeping the parking lot, cleaning floors, things that, frankly, a lot of hospitality employees have traditionally done as sort of part of their side work, but that is deemed not to directly support the tipped work. And because of that, it's considered not tipped work, and you can never take the tip credit. So you cannot take the tip credit for even 10 minutes, theoretically, if someone is required to go clean the bathroom. That's just not allowed. Then there's this middle kind of gray area, this middle bucket where it's work that does not necessarily produce tips itself, but directly supports the tip producing work. So the common examples they give, and there's loads and loads of examples if you read the rule and the comments to the rule that's published online by the Department of Labor. But filling and marrying condiments, rolling silverware, setting tables, preparing menus, things like that. That would be directly tip supporting work. And you can take the tip credit for that time with 2 exceptions. An employee cannot be required to do that kind of work for more than 30 minutes at a time. And they cannot be required to do that work for more than 20% of their total week, interspersed as it may be. So I think this is, the 80-20 rule in particular is challenging to comply with, because we don't make our employees clock in and out differently because they're slicing lemons for 3 minutes or whatever. What I think the practical solution, or the practical way I would approach this is, if you have a practice of having, well, first of all, if you have a practice of having clearly non-tipped tip credit ineligible work, if you have tipped employees doing that, that should always be done at the beginning or end of the workday, or some other time when they can very easily clock out and clock into a different rate code. As far and same thing with respect to like side work. If you have a practice, and I know many businesses have this, your shift starts at 11, you show up at 10:30 and you roll silverware, whatever. Or maybe you stay at the end and you do some stuff. If you have a period like that is 30 minutes or even frankly close to 30 minutes, you should also have employees be clocked in at a different rate during that time. And I don't think you need to make them clock in. It's not like when you make someone clock out for lunch because you don't want to assume how long the lunch is. If you have them clocked in at this different rate, and in fact, they didn't work the full 30 minutes, you're overpaying them. So I don't think it's a problem. I think that can be done by the employer at the end of the week. Just say, okay, you're clocked in from 10:30 to 3:30, and I'm going to give you the full minimum wage for the first 30 minutes and the last 30 minutes. Again, if that matches the way your practices work. The stuff that happens in between that 20%, I think is going to be less problematic if you don't have these larger blocks. I mean, realistically, no one is going to be able to tally up, the time that you, fill the bread basket, or the time that you, cut lemons or whatever. But I think you need to monitor it. And I would say, especially in terms of if there are routine slow periods of the day. So if there's always a lull of an hour or two between lunch and dinner, or the first hour, we're open at 11, people don't usually get there until about noon. If there's sort of these routine periods where there's downtime and people aren't actively serving customers, that's when I would worry a little bit more about the 20% rule. If it's people are busy all day serving customers and it's kind of naturally interspersed, I worry less about that.
We had a hand up at a time, and I think it was Yasmin. If the question still exists, feel free to unmute and pop in now. Okay.
He answered my question. Thank you so much.
Great.
So, that is, I think this is like kind of a new, thing that bears monitoring. This is a recent change to the rule. That 30 minutes thing is new. The 80-20 rule did exist, but I think that it's being, sort of more of a priority, and as well as the non-tipped work that I think is being a priority by the Department of Labor. So with that, I'm going to turn it over to Katie, and she's going to keep talking about some tip issues.
Great. Before I do that, the one area where I worry about this new rule, or one kind of establishment, would be those where, employees are in the process of preparing food and serving customers kind of at the same time, like like a fast food kind of industry, but or like a Chipotle, that kind of an industry, where if there's vegetable chopping happening sort of interspersed throughout customer service, it gets really hard to track. And so that's an area where there may be some places who have routinely taken the tip credit that want to rethink it. Okay, I'm going to talk about tip pooling first. A definitional clarification: tip pooling and tip sharing, those are two different concepts theoretically, but they're often used interchangeably. A tip pool generally contemplates employees, service employees, all contributing their tips to a pot, and then that pot being divided generally equally among the service employees. When I say tip sharing, I'm usually thinking of tipping out the back of the house, for example, tipping out the dishwasher, tipping out non-service employees who facilitated service. Mandatory tip pools are permissible under both federal and state law. So right now I'm talking about a tip pool that just includes service employees, the people who earn the tips. But there are some restrictions on what an employer can require. So the tip pool needs to be limited to customarily tipped employees. Cannot have a tip pool that includes the back of the house. Under no circumstances can management or owners participate in the tip pool or receive tips from the tip pool. So if you have a manager or a supervisor who's serving their own tables, truly has their own table assignment, they are entitled to keep the tips from those tables, but never shall their tips mingle with the tips of the other service employees. And a word of caution around this: who you and I think of as a manager. Dan went through the duties list earlier, supervising at least 80 hours of employee labor, hiring and firing authority, or recommendations given weight, management. We may put that threshold higher than the Department of Labor does. And I say that because I had an audit recently where the Department of Labor concluded that a lead server was management for purposes of participating in the tip pool. And the facts they relied on to reach that conclusion were that that person did some interviewing, did some ordering, did some scheduling, and generally was directing the work. And that made me nervous. So I wanted to highlight that. Just be careful. If you have any questions about whether somebody with kind of a lead capacity role might be classified as management, even if you're paying them on an hourly basis, keep them out of the tip pool. Oh, I jumped ahead. So identifying management, what the Department of Labor does is they look at the duties test. And my experience is that the threshold is really low. Now, interestingly or ironically, if you had classified that same lead server as exempt and we're treating them as exempt and not paying them overtime, the Department of Labor might view that differently and might in that circumstance say, oh no, that's a misclassification, that person's entitled to overtime. So sometimes you can't win. Tip sharing. There's a lot of confusion in this area right now, and that's because under federal law, there was an open question for a while, or disagreement among the courts, about whether an employer who did not take the tip credit, so they paid the full federal minimum wage, whether they could require tipping out to the back of the house or tipping out to non-customarily tipped employees, the dishwasher. That was relatively recently clarified that under federal law, yes, if you do not take the tip credit, you may require some portion of tips to be contributed to the back of the house. That is not true under state law. Under Maine law, the Maine Department of Labor interprets the statute to preclude any mandatory tipping out or tipping out to the back, or a pool where the back gets a piece of the pool. If employees are going to tip out non-service employees, I call it the front and the back, and hopefully everyone knows what I mean. I know that doesn't align with everyone's establishment, but by back, I just mean employees who are not engaged in directly customer service work, who are not customarily tipped. Any tip out has to be voluntary, and the employees have to handle that transaction themselves. And I've had a number of audits where the Department of Labor interviews employees, and sometimes what they'll find is that it was voluntary at a time, like 3 years ago, when all of the long-term servers got together and said, hey, we really all think it's appropriate to tip out the dishwasher X% and to tip out. But over the years, new people have been hired and have simply been informed, at this establishment, the servers tip out 3% to the back. They've just been sort of informed that that's the way it's done. That's the Department of Labor does not view that as voluntary. And so the consequences of having a tip pool that either includes the back when it shouldn't, or includes management, or a tip sharing, required tip sharing that's going to the back, is that the Department of Labor will invalidate the tip pool and take away the tip credit. Again, in Maine, possibly going back 6 years. And so to the extent you've been taking a significant tip credit, $6.37, that means going back and paying the other half of the minimum wage to every employee who worked at the tipped minimum wage for 6 years. So I'd say beware of all of this. We would like to see addressed in your tip credit notice. If you have if you have a tip pool, a mandatory tip pool, it could explain this is what we require. It's among service employees. And it could say very self-servingly, our employees are not required to contribute tips to the back of the house. To the extent they choose to do so, many choose to do so because those employees contributed to their service and to them earning those tips. To the extent they did that, that was voluntary. Yeah. I have a question that I'm going to circle back to just because I'm going to plow ahead right now, but let's cover that when we get to the end. Overtime, calculating overtime, I said this at the outset, this is one of the biggest areas where this is being done incorrectly in a lot of places. And so I think there's a very logical and natural way of calculating overtime when you have tipped employees, and that is to take the cash wage that you're paying them. Let's say that you're taking the full tip credit in Maine and that is $6.38, and to multiply it by 1.5, right? That's 1.5 times the cash rate that you've been paying them. If you do that, you're doing it incorrectly. What you're required to do is to look at you're required to calculate overtime off of the full minimum wage, and then you can back out whatever tip credit you're taking. So there's a lot of numbers on this slide, but let's say that you're a Maine establishment, you're paying a cash wage of $6.38. That means you're taking a $6.37 tip credit. The way you calculate overtime is you start with $12.75. You multiply that times time and a half, 1.5. That gives you $19.13. From that, you can subtract the tip credit that you took. It's ironic and just sort of circular that you end up with $12.75, which is the Maine minimum wage. The math doesn't always work out that way, depending on where the minimum wage is. If you did it the other way and just multiplied the cash wage by time and a half, you would arrive at a lower number. You'd be paying out overtime at $9.56. And so if the Department of Labor came in and saw that you had done that, they would assess that back overtime. In my example, I have been using the minimum wage of $12.75, but sometimes it will be more than $12.75. So if you pay bonuses, if you pay additional payments that are going to the employees other than tips, also need to be factored into that regular rate number before you multiply by 1.5. So we'll talk more about that in a second. And yeah.
Sorry, I didn't mean to interrupt you. Katie, I think there's a question in the chat. If you could just briefly address how tip pooling, would it affect the ability to require tip sharing with other direct service employees who make the minimum wage? So I think what the question is being asked is basically tip credit employees are in a pool. Can they be required? Can they include a employee who is a service employee but is not getting for which the employer is not taking a tip credit?
So the answer to that question doesn't depend on whether you're paying the food runner, whether you're taking the tip credit with respect to the food runner. The answer depends on whether the food runner is a customarily tipped employee. And so that food runner may be working in the front of the house, but if they're in a job that doesn't customarily and regularly receive tips, then they can't participate in the tip pool. And that Dan spoke a little bit to that earlier. There's a lot of law around, hostesses, around bussers, and I think, Dan, correct me if I'm wrong, but I think in many of those cases, service employees like hostesses and bussers will be considered, customarily tipped employees, but there are times where they're not based on the nature of their work.
Yeah, I think that's right. And I mean, without having obviously all details, but as far as a general question that was asked here, a food runner, I think a food runner is likely to be deemed a customarily tipped employee. And whether or not you take the tip credit, I don't think is what's material. It's are they customarily a tipped employee? And you don't have to take the tip credit just because they receive tips. So presumably they are receiving tips, and if they are, I think that would be appropriate in that circumstance.
Greg, chime in. I see Greg's hand up.
Yeah, I thank you very much. Excellent so far. So I don't know if you're going to address this. I didn't see it initially when you're in your list of things, and maybe you don't want to address it, and maybe I shouldn't bring it up. But I wondered if you're going to talk at all about blended rate, Because the
No,
way the labor shortage is such that people are doing all kinds of different things. So is that in here somewhere?
it's not, but I'm glad you asked it, and I'm happy to, I think now would be the time to talk about that.
Well, thank you
And
very much.
so I think what Greg is referring to is that, an employee who works at $15 an hour sometimes doing certain functions, but also works at $6.38 an hour serving customers. And so there you have two different hourly rates. There are a couple of different ways to calculate their regular rate. But one way is to have a very clear agreement with the employee that whichever role they're holding at the time they go into overtime is the role at which you calculate the overtime. So if they're working in the kitchen at $15 an hour, when they cross the threshold from hour 40 to 41, $15 an hour is the regular rate. In my experience, very few employers have such clear agreements like that with their employees. And so what the DOL requires then is what's called a blended rate. And so you're looking at the time that the employee, and I can't do the math, I'm definitely not a numbers gal, but you're looking at the time the employee spent at the $15 an hour wage, the time the employee spent at the $12.75 an hour wage, and you're weighting those two to come up with a blended regular rate. Does that make sense?
And I would just add to that, the way because the math does get confusing, I think the way that I try to conceptualize this is try to not think of the regular rate as an hourly rate, or at least not as primarily. It's not related to whatever the hourly rate is. You just add up all of the pay for the week that needs to be included, and then you divide by the number of hours they worked for the week. That's what their regular rate is. It's really not a function of a percentage or a multiple of what their base rate is. And I think that's what often confuses people.
That's a great point. Although now I'm going to confuse that point even further, because we're going to start talking about service charges, this is where things I think get kind of conceptually difficult. So if you find it that way, you're not alone. But like some of where I'm going, Dan and I had to really wrestle over. This much is clear. Let's just talk about a service charge that is recognizable, and that would be like a compulsory 15 or 18% gratuity added to a customer's bill for parties of 6 or more. All right, let's just deal with that example. Under federal law, that charge is not a tip. It's part of the employer's gross receipts. And because it's not a tip, it's not required to be paid out to the service employees. You may choose to. But if you choose to pay it out to the service employees, it needs to be included in the regular rate for overtime purposes. So I'm going to call it it's a mandatory or an automatic gratuity, even though it's a gratuity, if it's automatically charged, not a tip under federal law. Okay. Different result under Maine law. And again, let's just stick with automatic gratuity for now. We can complicate things with other kinds of service charges in a second. Automatic gratuity under state law, automatic 15% for a party of 6 or more, that is a tip under state law, under Maine law. And that is required to be paid out to the service employees. All tips need to be distributed to the service employees. So under Maine law, automatic gratuity is a tip. We don't generally include tips in the regular rate. Right? We look at the base wage and the tip credit, but not tips. That's not one of those. That's not something that needs to be included. Under federal law, if you pay it out to the employee, you must include it in the regular rate. And that means if you're a Maine employer and you have any kind of an automatic gratuity, that needs to be paid out to the employees, and it needs to be included into the regular rate for overtime purposes. I'm going to do a calculation on the next slide that hopefully we'll bring some of that together. State law is a little bit, I've been talking about automatic gratuities because that's straightforward under Maine law. Those are always going to be tips. But what about other automatic charges that you do not consider a gratuity? A surcharge or a kitchen fee or just some other charge that is not intended to be a gratuity. Under Maine law is very clear that banquets and private clubs can impose those kinds of service charges. And as long as they tell the customer this isn't a tip, They can keep that amount, they can distribute it, they can do what they like with it. Maine law doesn't say anything about whether restaurants, hotels that aren't banquets or private clubs, whether other kinds of establishments can similarly impose a service charge, make it very clear to the customer that this is not a tip, it's not going to the service employees, and do the same thing. And there's been some debate about that among everyone who talks about this stuff among all the wage and hour nerds for a number of years. And I can see the arguments both ways. On the one hand, well, the law doesn't say they can't do it. On the other hand, well, the law talks about banquets and private clubs. Why would it talk about banquets and private clubs if anyone could do it? It's an unresolved area of law in Maine. If notwithstanding the fact that it's an unresolved area of law, you're charging a surcharge or a service charge of some kind, and it's not gratuity, it's not supposed to be for the service employees, I recommend that you do be very, very clear about what that charge is and is not. I would not call it a service charge. And I would just make it crystal clear to the customer that this is not a gratuity and this is not going to the service employees, and just recognize that there's some risk.
And Katie,
Yeah.
I would say in your list of examples, the one that's most predominant at this point in time is the 3% kitchen charge, just
Okay.
to get that out there.
Okay,
Thank you.
so that's a good example of it. So, and that's, if it's a kitchen charge, presumably the name of it, I would argue all day, very clearly puts the customer on notice that that money is for the kitchen and it's to supplement wages in the kitchen. And I feel good about that argument, but as I just said, the law is just unsettled. It's one of those things that lawyers just can't give clear answers to that make people frustrated with lawyers. Okay, so some service charge takeaways. This consequence of having to include automatic gratuities in the regular rate, if you pay them out, that can really sneak up on you. So if you are not a banquet or a private club, and again, we're not talking about 3% kitchen charges. Let's focus on the 15% for the party of 6 or more. That's a tip. We all know that's what that's for. If you have that practice, just be aware that those dollars that you pay out to the employees will inflate their regular rate. Again, I'm going to give you an example on the next page, but it can create a very large overtime rate for those employees. So if you have these service charges that are tips that are getting paid out, you might want to be really careful to monitor whether they're working overtime, or be prepared to pay out a lot of overtime. Again, I'll take you through an example in a minute. All right, here's my example. So here's an example of calculating overtime with an automatic gratuity and how this would bite you. And note, I'm using a very large dollar amount of automatic gratuity. So we'll just assume that this server has a lot of parties of 6 or more. So you have a server, they're paid a cash wage of $6.38, and you're taking a $6.37 tip credit, okay? Let's assume they worked 45 hours this week. So we've got 5 overtime hours. Let's assume that they had a lot of big parties and you paid out to them $450 in automatic gratuity. Right now, the US, in my example, the Federal Department of Labor is coming in to audit you and to look at your compliance, okay? They're gonna look at what is the overtime rate that you're required to pay this person under federal law? Well, remember, $7.25 is the minimum wage under federal law, right? You paid out these gratuities, so these need to be included in the regular rate. That means that the regular rate is $17.25 an hour. Right? I took $450, I divided it by the 45 hours worked. That added $10 an hour to the regular rate. Does that make sense? I'm sure it does that for everyone, but I'll pause and we can talk about this when I'm done. So the regular rate is $17.25 an hour. You need to multiply that by time and a half. That gets you up to $25.88. And then you can back out the minuscule tip credit that you took under federal law, because you paid this person a cash wage of $6.38, minimum wage under federal law $7.25. So you took a very small tip credit. So you don't get to reduce that number very much. So this person's overtime rate is going to be $25 an hour. And that's all by virtue of this issue of this $450 in auto gratuity. Under state law, it's a tip, you're paying it out. We don't need to factor it for overtime purposes. But under federal law, it's not a tip. It's like a bonus. It would be the same as if you paid them a bonus of $450 that week. There are times when I just worked this out using federal law because I happened to know that federal law was going to result in a bigger overtime premium. Sometimes if the automatic gratuity that's being paid out is much smaller, I did an example before we started with way fewer dollars paid out. Where the auto gratuity paid out added only $1 an hour to the regular rate. In that case, calculating overtime under state law was more beneficial to the employee. And so that was what the employer would have to do. I'm going to pause for a second and see if anyone, this is the part where I said I thought heads would spin, and I'm happy to go over this again another time. All right. Some other, oh, we were almost out of time. Very quickly, other common overtime issues. We already talked about that one. I want to talk about joint employment briefly, because this is another thing that has bitten a number of my clients in audits. If you have more than one location, commonly owned, they can be separately incorporated. Doesn't really matter right now whether the seafood restaurant is an LLC and the ice cream shop is a LLP, and they have different names. And if you own two establishments and you're sharing workers between those establishments, you need to be prepared to combine the hours worked at each establishment for purposes of understanding whether the employee has worked overtime. So if an employee works 25 hours at the seafood restaurant and 25 hours at the ice cream stand, under many circumstances, the Department of Labor will say that employee worked 50 hours for one employee, and they're entitled to overtime for the 10 hours. They will not just regard separate incorporation status, separate names, separate, if there's common ownership, common control, et cetera. And then a quick word about Maine earned paid leave. Employers in Maine with more than 10 employees now are required to provide earned paid leave. There are certain exceptions for seasonal industries that I'm not going to get into right now, though for some of you it may apply. Employees are entitled to earn 1 hour of earned paid leave. So this is like, think of it as PTO for every 40 hours that they work, up to 40 hours in a year. This leave can be used for any reason at all: sickness, just any kind of emergency, vacation. You can prohibit them from using it during the first 90 days of employment, but they need to accrue it during that period of time. And employees need to be free to carry over 40 hours from one year to the next. However, if an employee carries over 40 hours, you don't need to let them earn any time that year. If they carry over 20 hours, they're only required to earn 20 hours in that next year. Some employers don't like to deal or think about the accrual process, and they'll front load all 40 hours. That works for relatively full-time employees. It might not work for everyone. Oh, I said 90 days. I'm sorry, it's 120 days. You can prohibit employees from using the EPL for the first 120 days, but they still have to accrue it. And probably relevant to a number of your establishments. If you have an employee, summer employee, for example, they come work for you this summer, they aren't going to be employed with you for a whole 120 days. They're going to leave after 3 months. They're accruing this time because you're required to accrue it for them over the summer, but they're not there by day 120, so they can't use any of it. When they leave at the end of the summer, you have two decisions. And this is not a whimsical decision. It's going to be in your policy. It's a decision you make for everyone, apply to everyone. You can pay out the accrued leave to them when they leave, just like paying out vacation. Or you could choose not to pay it out upon termination. However, if that employee returns to you next May for another season, that bank needs to be there for them. So there's some accounting issues there. I am just going to flag this issue because we're at time and it's a complicated issue, but there's a new law going into effect in January of next year around payout of vacation upon termination that raises some questions about whether what I just told you is still good law. What I just told you about how you can choose to pay it out or not pay it out, whether employers will still have that flexibility. But that's it.